In this week's episode of the Stock Scores Market Minutes, I'm going to talk about an important trading rule. I'll then do my regular weekly market analysis. We'll do some market scans in search of opportunity and look at the trade of the week on NEPT. All right, so this important trading rule, what is it all about? Well, typically investors will judge their performance or the success of their strategy based on the last few trades that they've done. And that's really not the right thing to do because trading is a probability game. We need to judge our performance over a large number of trades. Many traders will make this mistake because we tend to just use our closest reference, which is the last few trades we've done. But you have to really take your strategy and do the right thing over and over again and see how well that does. If you do the right thing consistently over the long term, you will succeed. But getting a good result from a bad decision is not good. It will hurt you in the long run. And if you do the right thing and you get, a loss, that doesn't mean that there's something wrong. It just means that that one trade didn't work out. And as an example, I want to show you what happened on Friday. The market was very strong the last few days, most of this past week actually. And on Friday, the market had been going parabolic to the upside. You can see that on the chart here. This is a 2-minute chart, so this is Thursday's trading action. See how the market was going parabolic like that? That is an emotional market. We'd been up 3 or 4 days in a row. We were gapping up on the open. And typically when that happens, there's a good chance for a pullback. And so my approach to the market on Friday morning was to not be too eager with buying stocks and to look for short selling opportunities. That was the right thing to do. But as it turned out, the market did what it probably should not have done. It continued to go higher. Not because there was something wrong with my approach, not because I read the market wrong, it just did the thing that would not usually happen. 70% of the time, the market would have pulled back on Friday. 30% of the time it goes up and you're trading the probability, and on Friday I got on the wrong side of probability, but that's okay because if I do the right thing over and over again, in the long term it will make money. All right, so let's get into this week's analysis, starting off with the US markets. And as I said, we had a good comeback this past week. If you recall, last week I talked about this downward trend line needing to be broken. Well, we did that late on Tuesday, and then continued higher through the week. You can see the nice upward trend line. So we have broken the short-term pessimism for the market. A little bit overbought because we've gone up so quickly. You can see the space here between the moving average and price. And anytime that space gets large, it means that the buyers are maybe a little bit too enthusiastic, push prices up a little too quickly. So we've got to be careful in that situation. We're also coming into some short-term resistance here. We'll see if that stalls the market early next week. But for now, it's a nice bounce. My expectation is we pull back a little bit, build a rising bottom, and then try to make a run back to those highs. Looking at the longer term chart, this of course the weekly chart, and we had that long-term resistance. We rallied up to it, we got stuck, we pulled back, and now we're breaking the pullback. You may recall I've talked a number of times in recent weeks about a correction and how it didn't really feel like we were getting a correction. And the reason was there was not a lot of enthusiasm among the sellers, not like we had back in October, November, December, or even back here where you really had strong, aggressive selling. This selling that we've had the past few weeks has been more of a drift lower as opposed to everyone running for the exit door at once. And that's why I didn't really feel like it was going to be a correction. It was not fun to watch the market drift lower, but it still wasn't particularly bad. And now we've had the snapback rally, and it feels like we're headed back to those old highs where we'll probably get stuck near term. Looking at the Russell 2000, it of course has been drifting lower as well. It stabilized last week. I wouldn't say it participated with the kind of strength that the broader market did, the large cap stocks. The small caps still lagging a little bit, but there was certainly some small cap movers last week, some really great traders, stocks like LJPC, for example, that made these big moves on single day runs that were quite fun to trade. And that's a good sign that shows that the retail investor is gaining some confidence again. On to the Canadian markets, looking at the TSX 60. It too made a little bounce and broke the downward trend line, but not with the enthusiasm that the US markets did. And part of that is because the heavy weighting of oil stocks in Canada, and they've been lagging a little bit of late, and so you're not getting that upside enthusiasm. Nonetheless, at least the downward trend line has been broken in the very short term. We still haven't broken this longer term downward trend line, and by longer term I really don't mean long term because this is still an intraday chart, but that is going to be a little bit of a barrier for the market. We'll have to see if the market can break that next week. Looking at the longer term chart, of course, we had that big run. We actually broke through resistance, but after the market had been going up a lot, and typically that's not a reliable breakout. Reliable breakouts are the ones that come from low volatility. This breakout came from high volatility, which is why there was a good chance it would pull back. It has done that. It's now in that little downward sloping channel. We need to break that and then hopefully make a run back to the highs. I think the market generally looks good, but still some uncertainty. We need to break that pullback near term. Looking at the TSX Venture, it has been in this downward sloping channel the last couple of months. And I think generally speaking, you have to be pretty careful with these stocks. There will be individual names that can do well, but in general, the overall market is not particularly exciting right now. Looking at currencies, the US dollar gave up a little bit of gains in the last week, and it actually breaks this little upward trend. And so it's from a high, it's not from a falling top. And that means it's not a real strong sell signal yet, but the US dollar has been very strong for quite some time. And this is one of the first moments in the last 4 or 5 months when we've seen some real weakness. And so we may be starting a little bit of a pullback. We'll have to see if we try to rally and fail to make a new high and instead make a falling top. That would be a bearish signal. So this is the first little bit of bearishness in the US dollar. It's not significant yet, but it is something to keep an eye on. And it contributes to the strength that we saw in the Canadian dollar last week, which is now testing that downward trend line that I've talked about over and over again for many months. But look at this, we've got a rising bottom on the Canadian dollar. And so if we can make a decisive break of that downward trend line, and we're very close to that now, we may see a reversal of this pessimism that has existed in the Canadian dollar for well over a year, year and a half. On to interest rates. And of course, we've had the bond market making really strong gains, which means interest rates have been going down. We stalled this past week. That's reasonable given the gains that we had the previous week. But this is still a bull market for bonds, which means interest rates going lower. And therefore, if you're looking to finance a new home, you've got low rates now, but they may get even lower. Looking at commodities, here is gold, which broke its little flag pattern last week. We talked about that. I raised my rating on gold. We've had good follow through this week, hitting this resistance here. Will we get stuck? If we don't get stuck there, we're probably going to get stuck at those highs. And so I think the short-term upside for gold is somewhat limited, as it will run into that resistance level. I expect it will stall there, maybe go sideways. So after the weakness in the US dollar last week, which helps gold prices go higher, maybe we'll see the US dollar bounce back a little bit this week and gold hit that resistance level and stall its upward trend. But certainly the gold chart looks better than it did just 3 weeks ago. And so look for opportunities in some of those gold names as the pessimism seems to have turned. Looking at the oil market, of course, we had pretty significant sell-off over the last few weeks, and that's contributed to that lag in the Canadian market. And this week we went to new lows, but managed to close very near the highs of the week with that long tail. And that is a sign that oil may be making its bottom here, coming into this trading range from a few months ago. And so I expect that we'll maybe try to build a base here. Will we start to move up again? We are quite oversold right now. So at least in the short term, make a little bit of a bounce, but I don't think that it is yet a healthy chart, and therefore be cautious with oil stocks. And finally, my fear chart, which of course is the VXX based on the volatility index of the S&P 500 futures. And this has been in this sideways range, elevated from really low levels, but nonetheless not particularly high, and not a good show of fear right now. The investment community gaining a little bit of confidence again after the sell-off that occurred through May. So my ratings then, neutral on US stocks on both time frames. I'm still bearish short term on the Canadian market. We haven't broken that downward trend line, but remain neutral long term. Gold, neutral long term, bullish short term. We have a good little short term rally in place, but recognizing that coming up to that longer term resistance, that's why I've stayed with the neutral rating on gold long term. Oil, neutral long-term, bearish short-term. It is trying to bounce, but it has some work to do. It was a good comeback for the bulls this week as the sellers were never able to get a panic going. We never had that fear-based selling, and the bounce back has come pretty swiftly. A short-term pullback is likely in the near term given the gains we've made, but beyond that I think we could still move up to the all-time highs, and that really should happen based on the pattern I see building. Oil is trying to stabilize and gold rallying but coming into resistance. Fear is low. All right, so let's do a market scan on stock scores. We're going to run the Canadian Stock Scores Simple Weekly Scan. This is a scan I like to run every weekend on both the Canadian and US markets in search of those good long-term charts. Now, the first thing you have to do is set your default chart up to a 3-year weekly chart. And once you've done that, it will remain as the default. So here is my 3-year weekly chart for this little gold company, Nighthawk Gold. That's a pretty good looking chart. You can see that we've been in this sideways range for many months and now breaking out, seeing some accumulation with the volume. I'd give this a 7 out of 10. Moving along to the rest of the charts here, we'll just slide through. We always want to look for breaks from low volatility. Now this is a stock that is not a buy today. It really gave the buy signal back here last summer, late last summer, when it broke from low volatility and then started to come up. And that was at roughly 75 cents. We're now about $1.75, so made really good gain. But that's the kind of thing that you want to look for, is these abnormal price breaks from low volatility. And as I cycle through these charts, that's what I'm looking for. Now this is a good continuation pattern for this resource company. You can see we were rallying, we made a flag pattern, and now we're breaking the flag. That's a good continuation pattern, probably heading up towards 350. I'd give that a 6.5 out of 10. Keep moving along here. Again, looking for those breaks from low volatility. Here's another one that looks pretty decent. Another gold company, SMF, Samafo. You can see a cup and handle pattern here. There's the cup, there's the handle, and there's the break from the handle. Some volume coming in as well. That is a 7 out of 10. And moving along, you know, a lot of these stocks not breaking from low volatility, which is why I go over them pretty quickly. I want to see that good pattern of breaking from low volatility with abnormal activity, a sign that the buyers are aggressively accumulating the stock in search of abnormal returns. We got one more page to go, and then we will move on to our trade of the week, which incidentally was one of the stocks that came up on this scan. And I don't think I see anything else that I like here. You know, there's a number of gold names coming up, but they don't all have great patterns. Shopify, really gone parabolic. It's a stock I'd watch for a sell signal. All right, so that's it. Let's head back to this and look at the trade of the week. And this was on Neptune, NEPT. So Neptune gave the entry signal right at the pink dot there, which is the action candle. You can sort of see the pink dot right there. And this is a 2-minute chart. That's my trigger point for an entry signal. However, it wasn't really breaking from low volatility. You can see there that it had been moving up for the previous half an hour. When that happens, I want to see a second signal. I want to see a sign that the buyers are really strong and not topping out on that stock. So the stock pulled back for about half an hour afterward. And what I would do is put a buy stop in right there. You can see there's a little blue arrow there. And that was the point when it moved above its action candle close. So that was the buy point. Using a $100 risk tolerance, it would require a position of 1,110 shares, which was $5,095 in capital. Now remember, you can leverage that 3 to 1. So the actual capital required to do this trade was $1,700. It ended the day at a 5.2 risk reward ratio, which means for every $100 of risk, you make $522. For $1,000 of risk, you make $5,220. Using that $100 risk tolerance, we'll call it a $520 gain on a $1,700 capital required. That's a 30.5% return for a one-day hold, a great day trade, and all found with that Stock Scores action candle. If you want to learn more about how to watch me and my screen as this unfolds through the day, go to the Stock Scores website, and under Trader Training, you'll see something there, or no, under Trader Analysis, you will see something there about the active live service, and that's something available to the active trader members of Stock Scores. You can monitor my screen all day long as these signals are being derived and identified algorithmically with some automated processes. All right, well, that has been the Stock Scores Market Minutes for June 10th, 2019. Hope that you have a great week in the market. Remember, subscribe to the channel, hit the like button, leave a comment if you have one, and most importantly, trade well.